welcome to this weekly installment of the Whitaker-Myers Wealth Managers, what we learned in the markets this week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at the housing market data. In point number 3, we'll take a look at the FOMC meeting update. And in point number 4, we'll talk to you a little bit about where the economy is headed and specifically take a look at 6 less common indicators that give us visibility and understanding or potentially give us insight of where the economy is headed. Now on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected negative 1.8% growth as of March 18th, which is a slight improvement from last week's negative 2.4%. Now, this is after incorporating data from the Bureau of Labor Statistics, or the BLS, and the Federal Reserve Board of Governors. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data rose by 3,000 claims, ending at 223,000, while continuing claims also rose to 1.892 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement again into 30-year and 15-year mortgage rates. However, this week we saw an uptick compared to previous weeks, ending at 6.67% and 5.83% respectively. We'll spend part of our discussion today talking about the housing market. As you can see on your screen, we've also updated the data for the U.S. existing home median sales price, which ended at $398,400 in March, and the lagging metric of median sales price for new homes ended at $446,000 for February. Next, we'll look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread rose slightly from a negative 40.13% last week to a negative 36.54% this week. Investors are continuing to feel quite bearish in the current market. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rises, often showing an inverse price action relationship to the S&P 500. The VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 19.28. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 14.3% probability of a 0.25% decrease and an 85.7% probability of no decrease in May. After the FOMC meeting this week, we received more information from Jerome Powell. Now, we'll discuss that in more detail later on in the video. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and income, but only when considered together, ended negative 0.11%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 0.54%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was negative 0.49%. Unfortunately, another negative week for these major indices as we are seeing more defensive play as most investors are waiting for April 2nd and the potential long-term impact of tariffs to determine their next steps. However, this week the S&P 500 was the smallest loser. I guess a win? Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On to point number 2, the housing update. The NAHB, or Wells Fargo Housing Market Index, or HMI, serves as a monthly gauge of single-family home builder sentiment, reflecting their confidence in current and near-term housing market conditions. The HMI is derived from a survey of builders who rate present sales, expected sales for the next 6 months, and traffic of prospective buyers. In March of 2025, the HMI was registered at 39. Now, this is a decrease of 3 points from February and the lowest level in 7 months, indicating a decline in builder confidence. This drop was driven by a fall in the index for current sale conditions to 43 and decrease in buyer traffic to 24, while sales expectations for the next 6 months remain steady at 47. The survey also revealed that 29% of builders had cut home prices in March, up from 26% in February, although the average price reduction still remained at 5%. Contrasting with the dip in builder confidence reflected by the March HMI, U.S. single-family home building rebounded sharply in February, increasing by 11.4% to a seasonally adjusted rate of 1.108 million units. However, the overall housing starts also jumped by 11.2% to a rate of 1.501 million units. The surge in home building was attributed primarily to seasonality trends. However, permits for future construction of single-family homes fell slightly by 0.2% in February, marking the second consecutive monthly decline, suggesting potential headwinds for future building activity. The number of single-family houses approved for construction but not yet started also dropped. There are several key factors that can impact the HMI and broader housing market. Rising construction costs due to tariffs and labor shortages were noted as threats to sustained recovery in home building. Builders in March reported facing elevated building material costs exacerbated by tariff issues, along with supply-side challenges like labor and lot shortages. Economic uncertainty potentially stemming from tariffs and governmental policies could also discourage potential home buyers. While mortgage rates have declined somewhat, the prevailing economic uncertainty was expected to keep some buyers on the sidelines. Historically, the HMI has been a useful indicator of booms and busts in the housing market. For instance, during the credit crunch and recession of 1990s, the HMI dropped significantly, aligning with a decline in housing starts. Similarly, the financial market crisis of 2008 led to an all-time low in the HMI index. The recent decline in the HMI in March of 2025, coupled with falling permits, suggests that builders are becoming less optimistic about the near future and single-family housing market, potentially signaling a slowdown despite the positive housing starts data from February. On to point number 3, the FOMC meeting update. During its Federal Open Markets Committee meeting, or the FOMC, that happened just last week in March, the Federal Reserve decided to maintain its target federal fund rates at 4.25% to 4.5% for the second consecutive meeting, signaling a continuation of its quote-unquote wait-and-see approach during this time of increased uncertainty in the economic outlook. This decision came as officials grappled with considerable uncertainty, partially attributed to aggressive and often chaotic policy changes. Of particular note was the Fed's announcement that, starting the following month, it would slow the pace of its balance sheet drawdown, or quantitative tightening. This shift was partially influenced by less clarity over money market conditions and an ongoing impasse regarding the government's borrowing limit. The Fed's decision occurred against a backdrop of economic cross-currents, while the potential impact of President Trump's tariffs are still being understood. While the Fed's primary focus has been on cooling inflation, economists warned that tariffs could lead to higher consumer prices. The central bank also released its quarterly economic projections, which indicated a slight downward revision for GDP growth in 2025 and a slight uptick in expected unemployment and core inflation, while still forecasting a couple of interest rate cuts later this year. The dot plot revealed that the Fed's maintained its longer run federal funds rate projection at 3% and its end of 2025 midpoint federal rate fund projection forecast to 3.9%. Drawing on our previous discussion about the housing market, the Fed's cautious stance and concerns about economic uncertainty align with the weakening builder confidence indicated by the March 2025 NAHB, and Wells Fargo Housing Market Index. The decline in builder sentiment was driven by lower current sales, decreased buyer traffic, and increase in the percentage of builders cutting home prices. The rising construction costs due to tariffs, as mentioned in our earlier discussion, as a threat to home building, could be a contributing factor to both the Fed's concerns about economic uncertainty and the declining builder confidence. While housing starts had rebounded in February, the slight fall in single-family building permits suggests potential future challenges for the housing market, mirroring the cautious approach adopted by the Federal Reserve in its monetary policy decisions. On to point number 4, where is the economy headed? We've been talking a lot about the economy and the various factors that drive our economy. Now, specifically, we've been watching very closely how the Atlanta Fed GDP Now report shows and looking at that trending. Now, on top of that metric, which is key, we're paying very close attention to the news on tariffs, counter tariffs, geopolitical events, regulatory changes, employment, sentiment, affordability, and of course, how the stock market is doing. All of these factors and more impact the economy. However, some economists have found correlations in, let's say, odd locations. As you can see on your screen, there's a list of some unusual indicators that some believe predict or correlate with economic activity. Let's talk a little bit more in detail about these potential economic indicators. And remember, and I'll say this again and again, that past performance is not indicative of future results. But these indicators do tell an interesting story. So at the core of these quote-unquote odd indicators is consumer spending. Keep that in mind as we dig in. So let's hop right into the rest of the conversation. The first unconventional indicator is the Big Mac Index, which was created by the economists in 1986 to compare purchasing power parity and currency values across countries by tracking the price of the McDonald's Big Mac. While initially a lighthearted tool, it has become a significant indicator of global economy and currency valuation, highlighting differences in Big Mac prices that suggest whether currencies are undervalued or overvalued compared to the US dollar. What is a key takeaway here is that the US dollar has lost most of its gains since the presidential election, leading to worries that an era of US exceptionalism is over, with investors potentially shifting towards previously underperforming markets like Europe and key emerging markets. As a result, foreign currencies have strengthened, and the Big Mac Index suggests that they might have further room to appreciate. It costs $5.79 for a Big Mac in the United States, while the equivalent in China costs $3.52 when converted to the yuan. The Mexican peso and Canadian dollar are also cheaper than the US dollar based on the index, while the euro may be overvalued by 2.8% and the Swiss franc could be 38% higher. Trade deficits and surpluses affect currency dynamics, and that foreign currencies have historically been significantly undervalued against the dollar. In some cases, the economists suggest that Big Mac prices have risen less elsewhere than in America, citing South Korea, where prices remain unchanged even as they increase by 10 cents in the United States. The second unconventional index is the Lipstick Index. The Lipstick Index is an economic theory that suggests sales of affordable luxury items such as lipstick, nail polish, and perfume tend to increase when consumers anticipate an economic downturn or recession. The underlying idea is that in a gloomy economy, people cut back on major discretionary spending but continue to purchase smaller, more affordable luxuries, which can have a positive psychological effect during stressful times, making them feel and look better. Leonard Lauder of Estee Lauder is credited with coining the term in 2001 after observing rising lipstick sales during a recession in the United States, suggesting an inverse relationship between economic health and lipstick sales. While the lipstick index is a popular theory and can be traced back to the post-World War II trends in affordable luxury, it's not economically proven. The phenomena is linked to human nature, as individuals may seek small treats to cope with economic stress, even if it's not on the most traditional and rational financial decisions. For example, during the pandemic, there was a significant spike in mascara sales, primarily due to high utilization of masks. The third unconventional index is the hemline index. The hemline index is a long-standing theory that suggests a correlation between skirt lengths, or hemlines, and the state of the economy. The common belief is that hemlines rise during good economic times and fall during recessions, with examples such as rising hemlines in the 1920s and 1960s, and their fall during the Great Depression and after the 1987 stock market crash. Despite its widespread promotion in newspapers and by economists, the hemline index has been debunked as a reliable economic predictor. Instead, fashion trends are influenced by a multitude of factors, including the economy, politics, social movements, and pandemics. Consumer psychology and the desire to reflect or react to world events also plays a significant role in fashion choices, sometimes leading to resistance against designer trends. In contemporary times, personal comfort, ethical considerations, and individual expression have become more important drivers of fashion than strict adherence to trends potentially linked to economic cycles. While the hemline index itself may not be a valid economic indicator, fashion can still reflect the general mood and circumstances of the world. The fourth unconventional index is the men's underwear index, or the MUI. This economic indicator tracks men's underwear sales to gauge consumer confidence and economic trends. Popularized by the former Federal Reserve Chairman Alan Greenspan, the idea is that basic necessities fluctuations in underwear sales reflect genuine changes in consumer behavior. During economic downturns, consumers may postpone buying new underwear, viewing it as a non-essential expense, while increased purchases signal economic or consumer confidence during economic recoveries. The same theory can be applied to women's underwear as well as socks. The MUI gained prominence in the 1970s and 1980s. While seemingly quirky, the MUI has shown some validity over the years, mirroring major economic events such as the Great Recession and the COVID-19 pandemic, whereas sales declined during the downturns and partially recovered afterwards. This suggests that the MUI can be a leading economic indicator, as changes in spending and basic items can precede broader economic shifts. The next unconventional indicator is Dr. Copper. Dr. Copper is a market term for copper metal, which is considered a reliable leading indicator of global economic health due to its widespread use in various sectors like construction, electronics, and transportation. The nickname suggests that copper has a PhD in economics. Now, all of this arises from the belief that changes in its price reflect changes in demand, which in turn correlate with overall economic activity. Copper's versatility and essential role in numerous industries make its demand a useful barometer for the broader economy. Its price tends to rise during economic growth due to increased demand, and fall during recessions due to decreased demand. Historically, copper prices have provided insights to economic trends, such as predicting the economic recovery of the 2008 financial crisis and signaling downturns like the stock market crash of 1929. The London Metal Exchange started trading copper futures in 1887, establishing a global benchmark. Despite its long-standing reputation, Dr. Copper has limitations. Factors such as supply disruptions, changes in mining practices, speculation, and significant influence of China's demand can affect copper prices independently of broader economic trends. Additionally, there can be a time lag between changes in the copper market and their reflection in the wider economy. While copper remains relevant in today's economy due to its renewable energy technologies, due to its use in renewable energy technologies, construction and manufacturing, and its correlation with inflation and emerging markets, it is not an infallible indicator. Dr. Copper's predictions have seen both successes and failures, highlighting the need to consider other economic factors, supply and demand dynamics, and government policies in economic analysis. Nevertheless, Dr. Copper remains a valuable tool in macroeconomic, financial, and industry analysis, providing insights to global economics, health, and specific sectors. And lastly, we have the cardboard index. The cardboard index is used by some investors as a way to gauge consumer goods production. The idea is that an increase in cardboard box production is a leading indicator of increased goods manufacturing, and as these boxes are commonly used for packaging and shipping. Conversely, a decline in production may signal a manufacturing slowdown. It's estimated that 75 to 80% of non-durable goods are shipped in cardboard. Therefore, higher cardboard orders are thought to be to reflect plans of greater production. However, the cardboard index is considered too volatile on its own to reliably predict economic trends and functions more as an informal rule of thumb. Official data on cardboard box production from the U.S. Federal Reserve has not consistently shown a leading relationship with GDP and can even lag behind. Despite its popularity, its usefulness should be viewed with caution, as the case with all of these indicators. Nonetheless, it's considered by some investors to be a reflection of aggregate business estimates of future consumer goods sales and can be used alongside with these other indicators. Now, throughout our conversation, we've discussed several other unconventional indicators. The Big Mac Index, which was created by The Economist, compares the price of McDonald's Big Mac across countries to assess purchasing power parity and currency valuation. The Lipstick Index suggests that sales of affordable luxury items like lipstick increase during economic downturns and consumers opt for small treats. The Hemline Index is a theory linking skirt lengths to the economy, with a rising hemline supposedly indicating economic prosperity. The Men's Underwear Index, or the MUI, tracks men's underwear sales with the idea that declines signal economic hardships and consumers postpone replacing basic necessities, potentially acting as a leading indicator. Finally, Dr. Copper refers to the metal copper as a leading indicator of global economic health due to its widespread use in various industries. Its price fluctuations are believed to reflect changes in demand related to the overall economy. While each of these unconventional indicators offers a unique perspective on the potential economic trends by tracking various aspects of consumer behavior or production, it's important to remember that they are not generally reliable predictors on their own. Factors unrelated to the overall economic health can significantly influence these indicators. It's generally advised to use these alongside more traditional economic indicators like GDP to gain a more comprehensive understanding of economic performance. And that's exactly what we try to bring you every week. Various puzzle pieces that come together and to provide the holistic picture so that you have a stronger understanding of our markets and their influences. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.